Would you sign up for 600 mortgage payments? Let's talk about the proposed 50-year mortgage. So currently the President of the United States has proposed a 50-year mortgage. The 50-year mortgage is a way to create more affordable housing, but potentially also put more people in homes. However, is that creating wealth or is that creating debt? The thought of a 50-year mortgage is bananas. Okay, so let me educate you a little bit. Back in 2008, there was a financial crisis called the Great Recession, where millions of people lost their homes, financial institutions were bailed out by the government, and in a way to put things back in perspective, there was a law called Dodd-Frank that was put in an act saying, hey, you cannot have a mortgage over 30 years. Now let's rewind back a little bit. There were 40-year mortgages for conventional and FHA loans back in one of the greatest real estate markets we had ever seen at that point, right? Expensive and high. Part of the reason Dodd-Frank was put into place was to get things under control, to regulate things more. So a qualifying mortgage is FHA, VA, USDA, conventional financing, right? If you hear someone say non-QM, bank statement loans, debt service recovery loans, asset depletion loans, those are called non-QM loans. Those loans allow for a 40-year mortgage, right? So more so on the investment side, they allow for 40-year mortgages. We can get into that later, but I want to paint a picture for you. So right now, currently, no primary residence mortgage loan can be over 30 years and be compliant with the Dodd-Frank rules, right? So in order for this 50-year mortgage to be taken into consideration, it's going to have to be compliant with Dodd-Frank, which is not going to happen easy. And there could be some time and things that they have to work out. Now, Bill Pulte, who's in charge of the FHFA, said, yes, they are actually working on, it is proposed to work on a 50-year mortgage to help create more affordability. Now, more affordability to the buyers by saving money, which I'll give an example in a little bit. However, it also is a way for big banks to make millions and billions of more dollars on the same homeowners and the same houses they're looking to finance. We got to take a few things into consideration, right? FHA, VA, and USDA are government-backed loans. Conventional financing is backed by Fannie Mae and Freddie Mac, right? Now, they're looking to go with potentially privatizing Fannie Mae and Freddie Mac, which then gives private equity firms more control and ways to make more money. Now, is this creating 40-year mortgages really helping people create more affordable housing, or is it to help strengthen those banks and private equity firms to get more money off of the American people so they're indebted for a longer period of time? I'm not judging which is which. However, do me a favor. In the comments, if you're watching this video, comment 50 if you'd be willing to do a 50-year mortgage. Comment 30 if you don't want to go past the 30-year mortgage. But let's get into the video as I break down numbers on the difference in monthly savings as well as savings over the course of the life of the loan, and how much you're going to pay in extra by stretching out an additional 240 months. So let's take a $300,000 house on a 30-year fixed mortgage, right? So on a $300,000 home with a 30-year fixed mortgage, a 6% interest rate, and for the purposes of this video, we're going to use a $200 a month homeowners insurance policy as well as $300 a month for property insurance. So that's 360 payments. We're going to show you the difference between 360 payments and 600 payments. That's an additional 20 years that you're putting onto your mortgage, right? So the monthly payment on a 30-year fixed mortgage, principal and interest, is $1,798.65. Plus the taxes and insurance gives you an extra $500 a month for a grand total of $2,298.65. That's a 30-year fixed mortgage. These are numbers that we're using. Numbers may vary in your area, okay? So on a 50-year mortgage, you're looking at a principal and interest payment of $1,579.21. Property taxes and insurance are still the same, which is equivalent to $500. That gives you a payment of $2,079.21. So the difference that you save monthly is $219 with the 50-year option. But you stretch that payment out over the course of an additional 240 months or 20 years. So let's look at the long term. You're saving $219 a month. Over the course of, for just principal and interest, you're going to pay on that $300,000 house, just principal and interest, total interest on that would be $347,515. That is what you're paying on the home in terms of interest. If you stretch it out to 50 years, the interest that you will pay will be $647,529. So you're saving $219 a month. So that $219 a month over that 20 years is going to save you $52,560. However, it costs you an additional $300,000 for stretching that payment out over the course of time. That is crazy. Let's think about it. For additional $300,000 that you're paying in interest, you could possibly have purchased a second home. That extra $300,000 could go into your retirement plan, or those additional funds could help you pay off some debt, or you could have paid your house off faster by putting down an additional amount, $219 a month. So is the savings worth the additional 20 years? Now, let me play devil's advocate, right? The purpose of this is to stretch out payments so that people can qualify for a house. So right now, if you currently can qualify for a house, $219 more would make a difference and get you up to a $300,000 home over the course of 50 years, right? So in that part, it allows for someone to come in, purchase a home, and qualify for it. The downside is, hey, yes, you qualify for it, but you're going to pay double, or if not double in interest, what the house is actually worth. So is it worth it? Now, the average person stays in a home for between 5 and 7 years. So what people could potentially do if they were to take advantage of something like this to qualify for a home is to have a game plan to pay it off early, so they're not paying the 50 years worth of interest, and or to pay additional payments to knock down the principal so that they're not paying the extra 20 years of interest on the property. And that's the same game plan that I advise people to do when they own a home and it's a 30-year mortgage. So let's look at the pros and cons of this loan. A pro is lower payment, about $219 less in this scenario, creates a short-term breathing room for a borrower, and it potentially allows for them to qualify for a house or qualify for more of a home within their price range and their location, right? Potentially easier to qualify. Lower payment could help them pay off, or it could help with the debt to income ratio. So, that additional $219 is a bill. Stretching it out could allow for them to qualify for the $300,000 house versus qualifying for maybe, let's say, $250 and not being able to purchase a home, or it being a harder way to purchase a home. Short-term relief, which allows for you to potentially save $219 that could go towards another bill to pay down some debt. So, those are some benefits or pros to the 50-year mortgage. Some of the cons to the 50-year mortgage, the biggest one is the $300,000 in additional interest that they pay over the course of the life of the loan. And let's talk about that. So right now, the average homeowner who's purchasing a home is around the age of 38 to 40 years old, right? So if they take on a 50-year mortgage, they're going to be 90 years old before that home is even paid for, if they stick with the 50-year mortgage and continue to pay the same payments over the course of the term of that 50 years. A lot of people won't see it, and what I would look at this is probably would end up being a multi-generation loan. So, you have to take that into consideration, that you probably will never get to see that 50-year mortgage paid off. And let's be honest, at the rate that people are buying homes now, between 38 and 40 years old, they may not even get to see their loan paid off, in 30 years because, at the age of 70. So, those are some things to take in consideration as well. Another con is if something happens in the real estate market and prices start to drop, you could be stuck or upside down in your mortgage for a longer period of time simply because it's stretched out for a longer course of time and you're paying down less. Something I want you to take in consideration as well. So understand, you say, hey, Kevin, how am I paying $300,000 more in interest on a home because it's stretched out over 20 years? So in a 30-year mortgage, in the first 10 to 12 years, a majority of your mortgage payment goes towards interest. And then you start to see more of it go to principal. And then probably around year 15, you start to see payment going more to principal and less in the interest. If you stretch that out over the course of 50 years, you're going to be paying more in interest for a longer period of time because it has been stretched out. If you could qualify for more home or have a lower payment, would you do a 50-year mortgage or 30-year? If you would do 50, do me a favor, comment in the comments 50. And then if you would do 30, comment in the comments 30. I'm Kevin Jefferson, the People's Lender. Thank you and have a great day.